In today's video, we're going to review the 8 proven strategies to increase investment returns. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one strategy to increase your investing returns is to decrease fees. This perhaps is the most significant drag on most people's investment returns, the direct impact on the cost of the financial services industry. It's not uncommon to see people paying 2 to 3% of their assets to advisory and fund management fees. 2 to 3% may not sound like much on surface, but when we put this into dollar amounts into a $10,000 portfolio, we're talking about $200 to $300 going into someone else's pocket instead of yours. When we compound this over many years, we could be talking about thousands, if not tens of thousands of dollars. When we can reduce these fees by 2 to 3%, it translates to a direct boost to investment returns. Now, what is the most straightforward way to cut fees? The most obvious way is to reduce the expense ratio we're paying for our investments. A fee charged by the investment firm or a fund manager if it's an actively managed fund. Let's say you have a sizable investment portfolio, around $1 million, and you've been paying 2% expense ratio, $20,000 annually because it's been managed by a fund manager. Again, in my book, unjustifiable amount given most actively managed funds fail to beat the market anyways. So you fire your fund manager and learn to be your own financial advisor. And you start to invest your money in low-cost broad market index fund. My favorite is the Vanguard Total Stock Market Index Fund, VTSAX, and it has an expense ratio of 0.04%. This translates to $400 in expenses annually. Versus the $20,000 you were paying earlier, you're automatically saving $19,600 a year. Money that is staying with your investment, compounding and growing your net worth instead of funding your investment manager's yacht. The number 2 strategy to increase your investment returns is to max out your tax advantage investment account. Another common drag on returns on top of investment fees are the effects of taxes. Income tax we pay to take money home, and capital gains tax we pay when we sell our appreciated assets. And the best and the simplest way to reduce this tax drag is to invest in tax advantage retirement accounts such as the 401k, Roth IRA, defined benefits plan, and health savings account, also known as HSA. When you invest in these accounts, your money is sheltered from tax. With a traditional 401k, you make contributions with pre-tax dollars, so you get a tax break upfront, helping to lower your current income tax bill. Your money, both contributions and earnings, grow tax deferred until you withdraw it. With a Roth IRA, though you pay taxes upfront, all the money invested grows tax-free and withdrawals are tax-free in retirement. Less money to the government translates directly to increase in returns. If you'd like to learn more about the optimal order of investing of these accounts, check out my video here where I delve deeper. The number 3 strategy to increase your investing returns is to invest tax efficiently. Even after you maxed out all your retirement accounts, there are still strategies to decrease some tax drag. There are naturally investments that are already tax efficient to begin with. Most often, these are stocks and mutual funds that pay qualified dividends, dividends that receive favorable tax treatment, and stocks and mutual funds that avoid paying out taxable capital gains distribution. Such distributions are typical of actively managed funds that engage in frequent trading in their portfolios. Most often, a broad stock market index fund checks the box on both of these, thus is a great example of an already tax-efficient investment. The dividends it pays are modest and mostly qualified. And because trading, the buying and selling in the fund is so rare, so too are taxable gains distributions. On the other hand, investments that are tax inefficient are those that pay interest, non-qualified dividends, and those that generate taxable capital gains distributions. Individual stocks, bonds, CDs, and REITs fall into this category. And because of their tax inefficiency, we would ideally like to keep them in tax advantage accounts that we talked about earlier, such as 401k and IRAs. Therefore, if we need to, we can fit tax-efficient investments like broad stock market index fund into an ordinary brokerage account. It doesn't mean it has to, but if we don't have any more tax advantage accounts remaining because we max them all out, then it is okay to hold them in ordinary brokerage accounts. And this is the same with broad international stock market index fund as well. Bonds and REITs are not as tax efficient. Therefore, you want to prioritize placing it in tax advantage accounts if you can. The number 4 strategy to increase your investing returns is to just avoid losing strategies. There are some investing strategies in my perspective that just doesn't work and should be avoided if all possible. Most often, success in investing, like life, is to just avoid big mistakes. One of the most common ones is investing in individual stocks. Regardless of what some TikTok influencers might say, the majority of us are just not good individual stock pickers. Brad Barber and Terence Odian are 2 behavior finance professors from UC Davis and UC Berkeley who have done some extensive studies about the average individual investor. Their research demonstrates some pretty interesting and consistent findings about the average investor. When it comes to investing decisions, if we're guaranteed to do one thing, it is to make the wrong call. We believe that we're ahead of the trend when in fact we're chasing them. We buy when the market is going up and sell when it's going down. There is no better way to lock in your losses. Talk about kicking you when you're already down, right? We get too caught up in the past performance and make decisions that coincide with our emotion rather than logic. And by holding undiversified stock portfolios, we underperform the standard benchmark. And this extends to other speculative investments such as precious metals, cryptocurrencies, and NFTs. I would even add actively managed funds in this bucket, given they're essentially grouping of just individual stock picking. My general rule of thumb is this: if people are too excited about a specific investment, I would bucket it under a potential losing strategy. Focus on slow and boring investments like index funds. The number 5 strategy to increase your investing returns is to ignore the noise. All the so-called experts that are constantly predicting the future. The truth is that experts who claim to know which direction the market is headed are nothing more than crystal ball gazers. In an annual letter to Berkshire Hathaway shareholders, Warren Buffett once said that the only value of stock forecasters is to make the fortune tellers look good. No one has more insight to know where the market is headed. But the sad reality is that just because they're clueless doesn't mean they can't do real harm. Because a lot of people do listen and use these predictions to time the market. When the market is tanking, selling might feel like you're making a wise move. And when you see the market continue to fall after you've sold, you might derive a bit of pleasure from it. But what happens is that most often, the pleasure is replaced by regret and stress because the market will always recover and now you need to time exactly when to get back in the market. And because timing the market requires incredible luck, we're often buying at the high. We lost money when we sold and we're losing money when we buy. A prime example of how this kind of behavior affects returns comes from a study conducted by market research firm Dalbar. In their 2020 Quantitative Analysis of Investor Behavior, QAIB, they compared the market returns versus the average actively managed mutual fund managers. They found that over a 25-year period, the market had an average annualized return of approximately 10%. The actively managed funds, only 7.8%. And the key factor to this lackluster performance came from the lack of patience on the part of the mutual fund managers. The average fund manager would typically hold the mutual fund only for 4.5 years before cycling with new fund that could potentially do better. And all this switching in and out really hurt the fund performance, losing to the patient market by more than 2%. And in reality, the loss is more than 2% because the actively managed funds charge more than the standard index funds. If you want to be a successful investor, particularly on a long-term basis, you'll have to learn how to tune out this kind of chatter. All it does is distract you from your own investment goals and strategies, and that won't help you in the long run. The number 6 strategy to increase your investment returns is to adjust your stock to bond ratio by dialing up your stock allocation. It's very important to understand that risk and returns go hand in hand. The higher the expected return, the higher the expected risk. If we want greater returns in our portfolio, we must get comfortable with greater risk. And our stock to bond allocation is a mechanism to control that risk level. Vanguard research shows the average annual return and the worst single-year return of various stock to bond allocation from 1926 to 2021. Let's say we want 100% in stocks, assuming the most risky asset allocation we can. The average annual return will be 12.3%. But in our worst year, we would have lost 43.1% of our portfolio. This means if we had a $100,000 portfolio in a single year, could see our portfolio lose up to $43,000 in value. This could be hard to swallow for many people, especially if you're expecting to pull some of that money out soon. So let's say we decide to go 100% bond, assuming the least risky asset allocation we can. In our worst year, we would have only lost 8.1% of our portfolio, which is much better than the 43% from our 100% stock portfolio. However, our average annual return is only 6.3%, half of what we'd have gotten compared to the 100% stock portfolio. We took less risk by going with 100% bond, but we also see less returns. If you want to increase your investment returns, you will need to dial up your risk tolerance and hold more stocks in your portfolio, regardless of how volatile it might make your portfolio. The number 7 strategy to increase your investment returns is to play the long game. The worst delusion that any investor can get him or herself into is the get-rich-quick mentality. I mean, why do we constantly have these bubbles? It's cryptocurrency and NFTs now. It was the housing market a decade ago. And before that, the dot-com craze. Dial back hundreds of years, and at one point, people were going crazy over tulips, having delusional thoughts that they could get rich overnight. The promise that you can double or triple your money in just 1 or 2 years, in all frankness, is quite ridiculous. Like building a great career or cultivating a healthy marriage, successful investing requires time and patience. When it comes to wise investing, don't measure your time horizon in months or even years. Look at it for decades. That's why I personally don't think an investment's monthly performance or even an annual performance really matters. What matters is the long-term prospect, the potential growth of American companies. If you invest $100,000 in an index fund with an average rate of return of 8% and hold it for 30 years without ever touching it, you'll eventually accumulate a portfolio of over $1 million. It's not a get-rich-quick scheme. And I know slow and steady is quite boring, but it is one of the most effective ways for regular individuals like you and I to accumulate wealth, and at the end of the day, that is what matters. Number 8 strategy to increase your investment returns is to add an additional asset class. To be honest, I really debated adding this strategy, given I think for most people, up to strategy 7 is enough. But if you've done everything in this video up to now, I would say it's okay to look at some other asset categories. The general rule of thumb is that if you're to add an additional asset class, you want to look for something with low correlation to the rest of your portfolio, different enough to make it worthwhile. With that said, keep in mind a pile of hay has low correlation to stock and bonds. So if an investment has low expected rate of return or is just too risky, take a pass on it. Don't justify your purchase in the spirit of low correlation. The most common investment that many people add at this stage is real estate. It enjoys a similarly high rate of return to equities, but with low correlation. And this is what my wife and I did as well. Of course, it sounds way cooler to say we're real estate investors versus index fund investors. But whatever other investments you explore, make sure to do your homework and evaluate it on its own merit. Thank you guys for watching. If you'd like to learn more about my personal evaluation between index fund and real estate, please check out my video here. Until next time, all the best.